I'm a CPA. Brad and I are partners in Hillhurst Mortgage, and we also have a CPA firm here, but I'm obviously more active on the mortgage side, but we love to give value to our realtors for tax issues and tax matters affecting real estate, so for themselves and their clients. So we love to do these sorts of things, and always consider us a resource. Like if you have, or clients have tax questions, not to step on toes of the client's CPA, but if you need a quick answer or something, we're always happy to give it. So, and that includes whether it's a owner-occupied residence, a 1031 exchange, investment property, you name it, we can handle it. Okay, if we don't know it off the top of our head, we'll get it fairly quickly. So this year is special because it's the first planning year for the new tax law, the so-called Tax Cuts and Job Act of 2018, which kicked in. So I don't know about, well, it depends who you ask about tax cuts. I think for my take is on, we'll probably, for the folks in this room, we'll do good with it. Other folks that are more W-2, 9-to-5ers, not so much. But hey, we're here. We're part of the good group, so let's take advantage of it. And the other question I had for you is, how many people here really do year-end tax planning? Brad, I know you do because you're a client, and I know you do. But who else? Okay, so basically, with
what do you mean by that?
Well, exactly. That was the next question. What is year-end tax planning? And what it is, it's basically, looking at where you've come year to date, starting January 1, 2018, up until now, and then where you are, and then what you're going to have in the way of income. Like you have escrows, they're going to close in December. How many of them are going to kick over to January? Because we're all cash basis. So any commission checks, received or constructively received in 2018 is taxable in 2018. Anything that can get kicked over to 2019 won't be taxable until 2019. So that's the step one. Step two is saying, okay, where am I at? What can I do to mitigate taxes? Like put money into a retirement plan. Do I got to buy that? Do I need that big old SUV for the kids? Which is going to be, of course, it's going to be 85% business. We're all in the same business. I mean, sure, you're going to take the kids to soccer practice once in a while, but for the most part, you're going from your house to the office, to all the brokers opens, to this, to that. It's business for the most part. I say on average, we find 70 to 90% is you guys are most likely using your car for business. So cars are, you can make year-end purchases. Brad, you got kids, you got family, you may want to purchase a new SUV. You may need,
I'm all about the electric anyway.
Okay, well, the electric car too. You could have an electric SUV, that counts too. What other assets, dig in, guys. What other assets do you have or need? Do you need a new computer? Because you can take a full deduction on things. The other thing you want to do is say, okay, for those of us like, Lexi, you have a corporation, you have to bonus yourself out and pay enough tax in by the end of the year, or you're going to get penalized. I see agents with crazy penalties every year because you either have to pay quarterly or you have to pay through withholdings. You're supposed to pay in all your tax as you go. And if you don't, you get penalized with, IRS calls it underpayment penalties. So with the underpayment penalties, they are very significant. So year-end tax planning is also not just to mitigate taxes, it's also to pay taxes to avoid paying penalties. So these are all sorts of things you could do. And we'll get into more as we go along here. A lot of new stuff that you guys that were at the earlier presentation we did kind of heard a lot of this already, but a lot of it is good stuff. And I just did 2 days of tax seminars. My brain is a little fried on it, but
do this then. It's all fresh, right?
oh yeah, something like that. After the bottle of whiskey last night to ease the pain, yeah. So basically, so we're gonna just cover what year-end tax planning is and how to achieve it, things you can do to reduce 2018 taxes, and then some of the new stuff, like the new mortgage interest provision, state and local taxes, the tax brackets, and other new provisions affecting real estate. Honestly, a lot of people don't do year-end tax planning. They just wing it, basically. And that's not good because you're costing yourself dollars. And it also, you're just kind of shooting into a black hole. Like, we're all self-employed. How much can you put in do you want to put into your retirement plans? You guys can put up to $56,000 in tax-free, or tax-deferred rather. So it comes right off the top. And you have until either, depends how what your filing status is. If you're a corporation and individual, you could put it in, you have up until September 15th to make the bulk of that contribution. And if anyone's, for the younger folks here, definitely should be putting something in retirement. And, that would include, not just a IRA, like a self-employed pension, a KEO, a defined contribution plan. There's a lot of things you can do. Now, the stock market's getting tanked right now, and we all love real estate better. I get it, but it's good to have a good diversified portfolio. It's good to have a little bit of rental properties, I feel, and a good stock and bond portfolio too, as it'll grow tax deferred, and you have a big nest egg when you go to retire. And the $56,000 is a pretty good chunk of change you can put away each year. Let's see, entity planning. Also, I know that some of us have corporations set up already, but if you're not tracking where you are and what your net dollar is after expenses, you're not going to know, hey, should I set up that S corporation? Should I set up an LLC? Are you thinking about buying properties? You really can't it's hard to monitor what to do unless you know where you're at. So how do you monitor it? Well, you have to have, it all starts with a good, basically with a good bookkeeping system, which we'll get into that too. It was actually the next line. A great accounting system. We probably do books for, 150 agents around town, and everyone's stuff is tight. It's reconciled. It's on QuickBooks. Every penny is accounted for. We know that if we see an expense to Toys R Us, it's probably not tax deductible. They went out of business, but some Disneyland or something like that. We also know that documenting expenses is important. What happens on Sundays at the open houses? Well, you guys have, open house, and you have like a platter of something. You go to buy something at Gelson's, cookies, or Taco Day or whatever. That, even though that's all legitimate business deductions, but to the someone just looking at it off the street, they'd see it, say, oh, that's a personal expense. So that's why it's mandatory that you track stuff as you go along. You can't just wing it. If the tax returns due 9/15 of 2019, you can't do all of 2018's books and accounting in September of 2019. It just doesn't. It doesn't work that way. You have to track it as you go. And there's a lot of apps, which I'll mention a couple of those. So it all starts with a good accounting system, and generally that's with either like letting us do it or getting yourself set up on a QuickBooks or some general ledger accounting system. Something like there's a lot of different ones. FreshBooks, there's a lot of stuff. It doesn't matter if you're a self-employed or a Schedule C. The IRS requires clean, accurate set of books. All income should be reported. All expenses should be well documented, meaning at the minimum, you should have proof of payment and a receipt and invoice. Notes should be documented on source documentation. Hot areas right now, travel, meals. Notice I don't say entertainment because that's gone. Open house expenses, auto mileage, and gifts. These are like hot areas that the IRS looks for. There's an app. We use this app called Everlance. Everlance has made it pretty easy. And you don't have to do it every day. I stack them up 5 days at a time. Oh, that was personal, business. Just swipe it.
It's kind of fun.
Yeah.
I'm waiting for them to come in. I'm like, good.
Yeah, exactly. And then the other thing is the receipts. You're out there to spend money on something. Just jot something down and take a photo of it. That's like the safe harbor. The safe harbor thing with the IRS under Section 274N is that you have proof of what you spent, where you spent it, who you spent it with, and a description of what was discussed. So it's pretty easy. I was at Desert Rose but I was with Brad, and I was, so a lot of it has to be documentation and should kind of correspond to some other documentation, like something on your calendar. And the person should be like a person you do business with or a potential person. So new client, hey, let's go for a drink. That's legitimate business meals. Entertainment is gone. But here's a question for you. Let's say you go to the Dodger game and it happens to be 18 innings. And let's say that you go there with a client. Let's say the tickets cost, just say $100 a person, and you spent the tickets, then you spent, just say another $100 on the hot dogs and the peanuts and whoever knows, whatever else. All deductible, partially deductible, or none of it deductible? Sid says partially.
No,
All.
Maybe the food?
except not the tickets though.
Yeah,
You
the
always get it
food,
right.
The food.
The food is deductible. The tickets are not deductible. Again, it's about documenting it. But Everlands has the ability to take a photo of the receipt, whereas other ones do just the mileage. And then the auto miles, yeah, that's through the app. Do you have a question, Margaret?
Travel, like if it's travel for pleasure, but then you happen to be working, because you're sole proprietors, like you just like, oh well, I am working, but I don't know, at the beach, and I just ordered a Mai Tai or something, and that's deductible, or how does that work?
Margaret, I knew you had a wild side to you.
Like, you just.
Yeah.
A rental car or whatever,
Look, if it's incidental business expenses, those are deductible. Like, let's say you were out in someplace in Oregon, you went to visit the local Berkshire office or Sotheby's office, whatever. That's cool. But what the abuse is that you would try to deduct like the cost of the airline, the hotel, all that. They look at the intent. What's the purpose of the travel? Is it personal or business? If it's personal and you incur some business expenses while you're there, that's cool. Or the other way around, if it's business and you incur some personal expenses, those wouldn't be deductible either. It's just what's the tax law is a lot about intent. Kind of like loans. If you intend to occupy the home, you buy it owner-occupied, then you mysteriously rent it out. I've seen those happen before. But it's about intent. What's the intention of the travel? So yeah, a fair game. But people in that case, what they normally do is try to write off everything, and that's where you get in trouble. It's just not legit. All right, let's see what else we got here. So this is an interesting one. This pass-through deduction, basically, it's a little complicated here, but basically here's the deal. First thing, you're going to hear this word SSTB, Specified Service Trade or Business. You guys, realtors are specifically not SSTBs. Okay, so what does this mean? 20% of your income from the business, your real estate business, is not taxable, tax-free. So if you made up to $315,000 for married filing joint, so if you made, $300,000, $60,000 is not taxable. That's off the top. This is huge.
And realtors qualify?
Realtors qualify. Yes. SSTBs are stuff like doctors, consultants, accountants, and other professional areas. But realtors are specifically omitted from this area. And they made it, yeah, from an SSTB. An SSTB is a little stricter.
It's stricter, but and I'm sorry to belabor this. Wasn't that sort of on the bubble where
Yes.
they were saying that they weren't sure if realtors were going to be classified
Yeah.
and considered a pass-through business?
Yes.
But where are you getting? How are you? What's your level of certainty, Doug?
100%.
Really? That's
100%.
great news, right?
Yeah, it's a great news. And then not only that,
S-corp or is that?
yeah, S corp
You have to
or
be an S-corp.
no, you don't have to be. That's another thing. The pass through. That's a very good question. The word pass through deduction. When you hear that word, that's like a buzzword. Pass through means a LLC or an S corp or a pass through entity. For you guys that don't have corporations set up, you still get it. Exact same. So it's a pass through deduction. You don't have to be a pass through entity to get the pass through deduction. So
And what are the advantages of of being designated a pass-through, like all of us in this room?
That
First 20% is not taxed?
is not taxed. Now, if you're over that, if you go over that, and again, this is not gross, this is net income we're talking about. So if it's over 315, it phases out at 415,000 if you are an SSTB. But again, none of us are SSTBs. Actually, I am. You guys aren't. Mortgage guys are. I think that'd be a pretty big push to say that we are not SSTBs, because it specifically said real estate brokers and agents. And they put agents in there just to be, so there wouldn't be any confusion if you had a broker license or just an agent license. Because the IRS kind of got a little heat from the tax court for another code section where they tried to push their weight around. They got slammed. But so it gets phased out if you are an SSTB. Now, if you're over 415, which you're the big agent, you basically still get the deduction. It's just calculated a little differently. And this is just my notes from the seminar. It's either A or B. A would be you take the lesser of 20% of the QBI. By the way, the QBI stands for Qualified Business Income, which is basically your commissions minus your expenses equals QBI. Okay? I don't know why they use all these fancy terms. But anyway, it's 20% of that number, or the lesser between that and, for those of you that have S Corps to take a W-2, half of the 50% of the W-2, or 25% of the W-2 plus 2.5% of the unadjusted basis of the assets. So it gets a little bit of a hairier calculation. Once you exceed $415,000 in net QBI. Excuse me. We have some clients that are over that. We have several clients that are actually north of $415,000 in, I think this year too, of QBI. So these calculations do come into effect. Everyone's a little bit different, and I can elaborate a little bit more on it. But what questions do you guys have right now? Because this one is a direct impact in your pocketbooks, and this will probably result in less tax this year than last year. All things being equal, you're going to pay less tax in 2018 than you would in 2017. But this is a biggie, so that's why I kind of dealt with it first. Sale of properties, you got to watch that 2 out of 5 year test. So the rule is you got to meet the use test and the ownership test, to qualify for the deduction. Ownership test simply means that you've owned it. Use test means you've used it as your primary residence 2 out of the most recent 5 years. 1031 exchanges only apply to real estate. That's it. No more, I've got a Picasso, you got a Van Gogh, let's swap them.
But is it only commercial real estate?
No, it's not.
I mean investment, sorry. I meant it has to be an investment?
Yeah, investment property, a rental property. So that's good. You kept that intact for us. No change there, but it kind of hosed everyone else. Alimony, no longer deductible. That's just for people, brand new divorces, people getting divorced in 2019 and going forward. So all the divorces, all the people paying alimony, it's already.
You're gonna get divorced now.
Yeah, exactly.
Divorced today. I literally got divorced today.
Today?
It's final today.
Okay, so are you? If you're.
We say congratulations.
I'm not going to make any comment on that, but I will just say that it's not. But if it's not deductible to the payor, I don't know what you are in this case, but nor is it going to be income to the recipient of the divorcee. Moving expenses no longer deductible. That's kind of a bummer.
What?
Yeah, yeah.
And this is for your business, or this is for just individuals?
Individuals. You guys sell a property. They move
That's,
to a new job in
that's
Buffalo,
for
New York.
2019 or for 2018?
2018.
So even,
Yeah. So that was a little bit of a little shot we took there. Entertainment, we talked about. No benefit there. Section 179. This is just awesome. They really loosen it up. If you guys have any investor clients that own commercial properties, you can go put on a new roof and pay $300,000 for a new roof. Write the whole thing off. You no longer amortize it over 31 and a half years.
On income property only.
Income property only, yeah.
Can it
What
be a
about on
single
your
family?
It can be single family if it's an investment property. Like you turned yours, converted it. If you do whatever work you do to it, you're gonna write it off in full. Oh, this is a big one. You know, this one I've had a lot of fun with this one. And actually, it's because of this code section. In that one, in the new code section, they made it clear: real estate agents and brokers. Because of this code section, this one is the one that if a lot of agents own properties, and if there's a loss from the rental properties, you can offset your commission income if you're a realtor, a real estate professional, and a contractor, other participating real estate groups. But the IRS challenged it big time several years ago and said that real estate agents were not real estate professionals.
What?
Yeah, exactly. What? And I'll tell you a quick story. There's this top producing agent out in the valley, and I really wanted his business bad. And I was like, Scotty, come on, throw me this, that. And he knew I was a CPA also. So he goes, hey, you want to review these returns for me? So I reviewed his returns, and I go, hey, he missed this. The guy, he owned some properties, he didn't take the loss. They were just suspended. So I amended the returns, rushed back to I got you $12,000 refund check. He's all excited, and I'm all excited. I think, all right, now I'm definitely gonna get a little business from this guy. so I give him the return. He signs it, sends it in the mail, and wouldn't you know it, and he gets I don't know. 4 weeks later, he gets a check in the mail. He's loving me. I think I got my first loan referral by then. Life's good. Then 4 weeks more go by, and he gets an audit notice.
No.
Ugh. He sends it to me. I'm like, their IRS is disallowing that. They want the money back plus interest and penalties. I'm like, ugh, what is this? So I call the revenue agent, and these guys, IRS. Here's a side note: the IRS has gotten really good with recruiting. They're all CPAs and attorneys that work at the IRS. They pluck people out of public accounting and law firms. So this guy was a CPA, very experienced, incredibly well trained. And I call him up. His name was Joseph. I'm like, Joseph, what that? And we start going at it. And we went at it for about 40 minutes on the phone, literally about. And I'm like, Face, this guy's good. And he's thinking, this guy's good. And anyway, so we just duked it out. It was pretty close. And then actually the guy that gave the seminar yesterday, he had been working on a case similar to this, where the IRS had these workshops and a task force holding these committees and workshops across the U.S. as to why real estate agents weren't real estate professionals. They were just going after this so bad and so hard. And he told me about it. The agent told me, and I called my guy, Abe Carno, he's just over here in West Hollywood, and I go, Abe, what's going on, and this and that? And I go, they're trying to disallow this. He goes, yeah. I go, you told me you had a case you're working on? So there was a couple up in Northern California, the Agarwal case, and they owned, this wonderful couple, they owned some rental properties, they're realtors, they did really well. And the rentals threw off losses, and they took them. And the IRS just disallowed them, just like ours. Went to appeals. He was telling us the story yesterday, as a matter of fact, which I hadn't heard before. Appeals just slammed him, and so they litigated it in tax court. That was their last hope. And so the tax court took this case, and I'm looking at the facts and circumstances. Heck, you could plug my guy's name in there. So exactly the same. Tax court gets this thing, and by the way, the guy's holding the workshop was some mucky muck IRS guy. Anyway, tax court gets it, looks at all the facts and circumstances. And this guy, by the way, was telling me, because an agent works at Coldwell Banker or Remax or Keller Williams or Sotheby's, that means they're not real estate professionals. I'm like, huh? What?
That's a very weird argument to make.
Anyway, he had some pretty good juice with him, though. I don't remember. He was pretty juiced that day. It was he was a handful. Anyway, bottom line, tax court got it and just slammed the IRS. Slammed him hard.
Awesome.
and said, absolutely, they are real estate professionals. The IRS has not challenged this thing since, and that's why in the code section 199 Cap A, they put in there real estate agents and brokers. That's why.
Unambiguous.
I wonder if they remembered me. I don't. Probably not. But we gave him
Guy get off because of that?
no change. He kept his money. They were done. He hasn't. And I,
Did he give you any business?
oh hell yeah! Oh hell yeah! You kidding? Oh yeah! All right. So that's my little story on that section. So moral of the story: if you have rental properties, you should be getting the losses. Brad, you're going to make out really well with this because you're going to take depreciation on your house that you converted to rental. You're going to do really well with that.
Sticking to rental income real quick.
Yeah.
It's a bit off topic, but I had heard that you can, because there are caps on property tax write-offs with the new law.
Yeah.
With income properties,
Doesn't apply.
there's no cap.
No caps.
So you can write off that entire, all that,
Oh, 100%.
all the taxes
Yes.
on income.
Only that SALT, state and local tax thing, applies only to your primary residence and second home combined.
So there's a
Ten-
real incentive to own income properties.
Yeah. Oh yeah. Oh yeah. Especially if you're a realtor and you have this section.
But I'm not a professional.
No, well, in my book, you're a professional, Brad.
Now you are.
All right. So standard deduction for those of you that don't own a house, $12,024. This is great news. So if you don't own a house, you can take a $12,000 standard deduction. And if you're married, $24,000. Of course, if you own a house, the mortgage interest will probably be more than this. Medical expenses only to the extent of 7.5. So if you did have a lot of medical expenses, this is an example, tax planning tip. You want to load them all into 1 year, if you can. So if you have stuff that's due in January, pay it in December. By the way, charging something on a credit card is the same as cash. So if you go on a shopping spree on December 31st and you buy a new computer and anything you charge in 2018 with a credit card is considered cash, fully deductible. So go to the Apple Store, get a new iMac or a new MacBook, whatever you need, do it now because all that will be tax deductible. Oh, the new mortgage interest up to $750,000. So $750,000, that's for our. Everyone understand that one? That's the interest on acquisition indebtedness up to $750,000. So if your client buys a house, they can take a loan out. It's from Brad. Brad gets them a good deal at, XYZ Bank, and they get a loan of $750,000. All the interest they pay on that loan will be tax deductible. If they get a loan of $1 million, only 3/4, 75% will be deductible. The old tax law, it was up to $1 million. New tax law, $750,000. And here's another little, just a FYI, there's two types of mortgage interest. There's acquisition indebtedness and home equity indebtedness. So acquisition indebtedness, anything to acquire, build, improve it. Acquisition indebtedness, anything else, home equity indebtedness. You go get HELOC to go pay for college or something. That's home equity indebtedness, not deductible.
What about cash out refi?
Cash out. So you look at the cash out, what it's used for. If it's used to improve the house, acquisition indebtedness, fair game. State and local deduction, the so-called SALT deduction. This is the one, Brad, you were thinking of, the $10,000 limitation. Only personal though, not business. Okay? And that's combined to everything, by the way. That's not just property taxes on the house that you live in. It includes your state income tax payments, your DMV fees. All of it's limited to 10,000 max. Obviously, the states hit the hardest: California, New Jersey, and New York. And this is why, actually, Brad, now that you mentioned, this is why I was saying that this is not as big of a deal, because like in this example here, clients that ask you, I'm sure you guys get this a lot with the supplemental bills, and they say, hey, should I pay my April installment in December? Not really. It's raw kind of, there's no benefit to really accelerate the payment on it anymore. What would be good, I'd rather see them pay how you have a mortgage payment due on the 1st of every month. They're better off paying the payment due January 1st, paying that in December. and taking that interest write off in 2018 versus 2019.
I mean, I never want to get into too much detail with taxes with clients, but I think this is a really big, everybody talks about this cap on the property taxes being 10 grand, and I think pointing out like, hey, it's not as big of a deal as you think it might be. Chances are you weren't getting the full benefit on your tax, on your
Right.
Previous to this.
That's
But
right.
I think it's a good conversation for people who are.
I think I would say absolutely.
It's
I would say that the clients that this doesn't impact as badly as mainly the clients that we've been working that are our clients, because they're getting hit in the old tax law. They're getting hit with the AMT.
right.
You know, and 6 to 1's a half a dozen to another. This is more.
Meaning they're W-2 employees that make some decent money, they would most likely be using their alternative minimum tax
They begin hit with the
strategy? Yeah, okay.
exactly like they had most likely had some things that triggered the AMT, and therefore and the taxes being one of them, but they probably, even though you could look on the tax return, you'll see, $35,000 of tax deductions for property tax, state and withholdings and all that. It looks like, all right, I got it, but then you go back to the AMT page and they're basically, deleting them all out, and they're compensating that by paying more alternative minimum tax. So this is a very benign thing.
Yeah, but it's huge.
It's huge though, because it's like that's what everyone's talking about, but it's a very benign to our clients. Like this example I put here, in this one on the, notice I put Coach Doug's. Yeah, you like that? The new SALT provisions looks like a bigger deal than it really is. On the surface, an individual that makes around $200,000 has a house assessed at $900,000 for property tax purposes would incur approximately $25,000 in state and local taxes, but effective 1/1/18 would only be able to deduct $10,000. However, it's unlikely that this person would get much more than $10,000 anyway, with or without the new SALT provisions due to AMT, which has been in existence for years. So this is really kind of, now it has a little more impact on other lower incomes, but for our clients, it's pretty benign. All right, so yeah, you're right, Brad. Thank you for that. Just a little bit more on the mortgage interest deduction. That we're limited to up to $750. I don't know. I have a client in escrow right now for $2 million, and she's putting $500,000 down. She's not too worried about the mortgage interest deduction, but some people are. She'll only be able to write off half the loan, basically. The new tax rates are lower. They 10, 12, 22, 24, 32, 35, and 37. So the capital gains rates are 15, 20, and 25, depending on what your income level is. So for those that I think to be in the 25% range, you have to have taxable income of around $430,000 plus something. The 25%. So the capital gains rates are based on what the taxable income is. So if your taxable income's generally, for all intents and purposes, 20% is going to be the main number. Now that's federal only, and you got California also. But if you're out there at a listing appointment and they ask you, hey, what's how much? Let's say it's a rental property they're selling, an investment property. They're probably going to be looking at about, a guesstimate of about 30%.
20 plus 10.
Yeah, 20 plus 10, exactly. Here's the tax brackets here. Current law is the old law. The one on the right is under the new tax law. So you can see the differences there. But when you start getting in the higher tax brackets like 32, you can see that it kind of recaptures back a little bit to where the new tax law catches up a little bit quicker. Like look at the 32, look at the 35%. See that?
Yeah, you were better
my
off at the old tax law.
Yeah.
Even though the rate's more, you can see, because look at the rates, like, see it goes, look at say at the 28%, versus 24%.
They're penalizing people that make between 2 and 350.
Exactly. They're
in
kind
the
of,
new tax law.
yeah, hitting that a little bit hard, which is kind of a lot of us. So that's where they, but overall, the rates are a little less. Then don't forget you have the 20% exclusion. So that's separate from this.
And the ordinary income, Brad, just to go back, if you do have an S corp, the ordinary income goes. This is based on what goes through to your personal return.
Correct.
Okay.
The S corp pays no tax.
Right.
All it flows through.
Flows right to the person.
Right. So all these, the only thing you pay on the S corp is on the net income 1.5% for California only, but 0 federal. Everything goes through the personal. Well, yeah. So who's here has S corps? Lexi and Brad and Joe and Margaret. So you guys have been you've had them for a while. You guys are getting the, the fact that it's just it's a pass-through entity. It all flows through your personal. But yeah, that's exactly right. It flows through, and whatever it is, that's what you pay. Okay, let's see. Tax tips for agents. Again, how to stay out of trouble with the IRS. Auto. This is a good time to clean. This is a really good time of year to do a little December, not spring cleaning, but just winter cleaning, and get your stuff. See where we are, where you're at, and we all have other stuff to do other than go through paperwork, but nonetheless very important. And we should find out where you are, and then figure out how to tighten up your documentation going into the new year, and what you could take advantage of. What taxes should you take how much should that salary check be? That bonus check, and how much are we going to put away for retirement? That's where tax planning is just critical. Also, you all have assistants, and I would highly recommend you put them on regular W-2, make them employees. Because according to the EDD, there's no such thing as independent contractors, and
Unless those employees have an S corp themselves.
That's the best. That's in fact, I had that conversation yesterday at the seminar. I said the only way we're going to pay people going forward is either W-2 or their corporations. Period. That's the best way. That you're okay. If you're paying an S corp,
As a 1099.
They're
an S corp.
exactly. So tell them
It's
to
the
incorporate.
only way you should do it.
Yes, or make them a full-on employee. Also, year-end tax planning. You could figure out your retirement deductions. When you could look at putting your spouse on payroll, putting some money away in his or her retirement account. Should you incorporate? Does it make sense? What are the requirements? These are all things you'll know once you have everything together, and once you have everything tightened up. So, year-end tax planning is a big thing. It takes a lot into account, and it should be done every year about this time. So it's so timely that we're doing it right now.